At GFOA, we believe in investing today in tomorrow's government finance leaders. The Leadership Development Scholarship makes it possible for dedicated public finance professionals to attend one of GFOA's 3 leadership academies, a program designed to build skills, confidence, and the connections to lead.
I've learned things about myself that I definitely can work on, but then also some strengths that I didn't realize I had. I'm going to take a lot of this knowledge and this information back, and I'm already starting to think of ways that I'm going to implement it. I thought the scholarship was just a great opportunity.
I feel I can do more for my staff to do more professional development, which is one of my goals when I got onto my position. So it helps pay me back for that.
Without the scholarship, I wouldn't have been able to afford to come downtown for a whole week. So to kind of put myself out there, go for the opportunity, I was so thankful and grateful to get that scholarship.
I've found from the past leadership academies, they will be friends and colleagues for life, and they'll call each other when they have ideas or need help. We really have a strong, engaged community.
With your support, we're building the next generation of leaders in public finance. Apply or donate to help make it possible.
I'm excited to invite you to GFOA's 120th annual conference from June 28th to July 1st. As we celebrate this milestone, we'll return to the city where it all began, Chicago, Illinois, our home base, a vibrant city known for innovation, beautiful architecture. We're planning a dynamic conference with timely sessions, networking opportunities, and a chance to engage with peers who are shaping the future of government finance together. Whether it's your first conference or your 15th, this will be a special experience that you do not want to miss. Registration is open now at gfoa.org.
Hi, everyone. Good afternoon. I want to welcome you to the GAAFR Plus webinar today. We have a smaller group. I am excited to actually be speaking with just about 13 of you. We're going to hit record here in a minute. Please jump in, use the Q&A. I'm also going to encourage you to bring your questions to the GAAFR Plus community. I have a slide on it. We are going to be recorded, so I've got someone in the background answering questions. So I hope to answer or at least be able to pose questions that others are having and encourage you guys to come to the community with it. All right, Karen, you want to hit record and I will get started with the official content.
Thank
Recording in progress.
All right, welcome everyone to our April 2026 GAAFR Plus webinar. Today we are going to cover two recently issued exposure drafts from GASB. The first one being on implementation guidance around the definition of subsidies coming from GASB 103 and applicable to proprietary funds. And the second one being on infrastructure assets. So we had a preliminary views on infrastructure assets about this time last year that we were sorting through and talking about. And now we have the exposure draft. So things have changed from that preliminary views. So I will touch on those changes as I see them. I'm Susanna Filipovic. I'm a manager in GFOA's Technical Services Center. So I will be teaching with you today. Todd is in Kansas City at a national training of ours. All right, some housekeeping items for you earning CPE credit today. Stay logged in. Ooh, this is not a 100-minute slide. This is a 1 CPE credit. So you need to stay logged in for the entirety of the session, about at least 50 minutes. You need to respond to 3 CPE verification questions. So after we combine those records, your attendance records from Zoom, your responses to the CPE questions, we match those records and award you the CPE certificate in our learning management system. The CPE verification polls are going to look like this. Are you there? Yes or no? I will announce them as they are launched, as I see them on my screen. Please be timely and get your responses in. Again, 50 minutes, 3 CPEs for this session. All right, as I mentioned, Todd is in Kansas City at a national training teaching live this week. I'm with you for the virtual webinar. In the background, we use the Q&A function, so the chat is locked. You cannot use the chat in the webinar, but use the Q&A to get in touch. We have Melissa Oten, another member of GFOA's Technical Services Center, in the background to answer questions, but I'm seeing some repeat names on our attendee list. You all are likely here because you know how complicated, especially the subsidies definition work is. If you have a question, you can bet that others in your, preparer governments have similar questions. So please leverage the GAAFR Plus online forum. Come here. This is a smaller group. All of you are here because you are very interested in accounting and financial reporting. This is not the general forum of GFOA, smaller community here. Post your questions. We watch this area. You'll see as questions are posted in GAAFR Plus, GFOA staff are actively participating in the conversations as well. So as you have questions, as you see things, please, you can post them in the Q&A. We'll do our best. A lot of the facts and circumstances questions are difficult to answer in writing. But if you post in the general forum, we will do our best and we'll keep an eye on it. We also have an upcoming article in the Government Finance Review that is getting drafted right now with good questions on GASB 103 and, proposed answers to them as well. So I'm definitely interested in what you guys are thinking about and what we're struggling with. All right, so GASB 103, I have a few slides on the background here. These are financial reporting model improvements, right? And we are quickly approaching our required implementation date. So our June 30th, 2026 fiscal year ends are required to implement this. We do know, and I know at least one of you are on the line, that we have some early implementers. It's more required early implementation. So component units that roll into a government with a June 30th fiscal year end are required to be implemented by that date. So we have seen some 1231 governments and a 331 fiscal year ends that are early implementing because their financials are rolling into another government's financial report. So keep your eye out for that. The statement itself is required. Those are the implementation dates. We do have some GASB 103 questions coming from Implementation Guide 2025-1. And the implementation guide questions coming from 2025-1 are required to be implemented along with 103. So those have been out for a year now. We talked about those at the GAP update last year. What we're going to be talking about today is the most recently issued exposure draft of an implementation guide on subsidies. Subsidies is specific to proprietary fund reporting, which we know GASB 103's impact on proprietary funds is, kind of the largest impact coming from that standard for a lot of governments. And the definition and the identification of subsidies in our operating items, revenues, and expenses in the operating statement is a more challenging component of implementing 103. Unfortunately, we are not going to have a final implementation guide on subsidies. The exposure draft is out right now. Comments are due this month, at the end of this month. I have a slide on that coming up. But the final implementation guide is not expected to be issued until September. Okay, so that is challenging for our June 30th fiscal year ends. You're going to be in the weeds working on your financial statements and the implementation guide. If there are questions that potentially impact your reporting, could present some challenges. The effective date is actually required for 2027, but it is encouraged that governments would be implementing the implementation guide alongside the implementation of 103. So for 1231s, we can do that. For June 30th, a little bit more challenging. Something, if you are a June 30th government, please keep your eye on that and think that one through. All right, so big picture changes made here. We have 6 main changes coming from GASB 103. I'm not talking about all of these today. I'm going to focus on the proprietary fund piece, but your management's discussion and analysis, the contents in the MD&A are changing, so keep your eye out for that. If you report discretely presented component units in your financial statements, there are a heightened emphasis on the reporting of major discretely presented component units versus non-major. And that's a qualitative conclusion. There is no bright line numeric threshold that we use to identify what component unit is major versus non-major. Presentation of budgetary comparison information. So for your general fund and your major special revenue funds with legally adopted annual time-based budgets, the location and information in those budgetary comparisons is changed with 103 as well. Unusual or infrequent items terminology is replacing extraordinary and special items. Still a very high bar to identify something as unusual or infrequent, in my opinion, but that terminology is changing and potential reporting implications for governments are changing too. All right, proprietary funds. We have new definitions for what is a non-operating revenue or expense. So our classifications between operating and non-operating in the proprietary funds statement of changes is expected to change. We have a new bright definition for what is a subsidy, and that will impact where those revenues or expenses are reported here as well. Some domino impacts on the statement of changes impacting the statistical section for standalone business type activity reports as well. All right, so we're actually let me back up. This is the main box that we are talking about here. New definitions and classifications and the format of statements. That's what we'll be focused on today, as it's what the implementation guide exposure draft is focused on. All right, so prior to GASB 103, governments defined what was reported as revenues or operating revenues and operating expenses. We put that in our note disclosures. We said these are what we define as operating. Everything else defaults into being reported as non-operating. With the implementation of GASB 103, we now have a GAAP definition for what is non-operating revenues and expenses. And there are 5 things listed here, subsidies being one of them. Contributions to permanent and term endowments received, always non-operating. Revenues and expenses related to financing, investment income and expenses, and resources from the disposal of capital assets and inventory. Those are always going to be non-operating, except if you meet the asterisk note here in blue, if it is the proprietary fund's principal ongoing operations. If one of those activities is the principal ongoing operations, it would be classified as operating. So if we were a proprietary fund that was an investment pool, maybe investment income and expenses would be the principal ongoing operations. Also related to financings, if we were a leasing entity, always going to be meet that principal ongoing operations and would default again would move from non-operating meeting the definition into operating revenues or expenses. So keep your eye out for those impacts again, everything else, and we'll talk on the next slide about what subsidies are, because subsidies received, incoming, inflows, and provided, outflows, are always going to be non-operating revenues and expenses. Operating revenues and expenses is now the default category on our statement of changes for proprietary funds. So if it does not meet the definition of non-operating, it will default to being reported as operating revenues and expenses. So this is interesting, okay? And I do want, it is a mindset shift. It's going to require some note disclosure updates if you have proprietary funds, because again, we're in the habit of presenting in our note disclosures what we define as operating. We're no longer defining operating. It is a GAAP requirement. What we are reporting is non-operating. All right, so let's dig into subsidies. That's going to take shape here as we enter into the exposure draft Q&As. So subsidies are going to be resources received in flow into my proprietary funds from another party or fund for which the proprietary fund does not provide goods or services to the provider. And the receipt of those resources, directly or indirectly, keeps the proprietary fund's current or future fees and charges lower than they would otherwise be. So the example we've been giving is a community college that reports as a business type activity, receives state appropriations that fund their operations, right? The state is not receiving goods or services from that transaction. And the receipt of those appropriations does directly keep the community college's fees charged to students lower than they would otherwise be. So there's an example of those resources receive the inflow. Subsidies can also be resources provided outflows. Could be subsidies. We can have positive and negative numbers in our subsidy presentation for proprietary funds. So resources provided to another fund for which the recipient does not provide goods or services to the proprietary fund. So we're passing money to somebody else, we're providing money to somebody else, and we're not receiving any goods or services in return. Also that those resources are recoverable through the proprietary fund current or future pricing policies. So the proprietary fund's rate structure has the ability to recover these outflows or finance, that's a heavy word, fund these outflows. All other transfers. It does interfund transfers within a government are always going to meet subsidies. Transfers into the proprietary fund, subsidy. Transfers out of the proprietary fund, subsidy. You don't have to go through these the dual test here of the sub bullet points if it is a transfer. All the transfers are going to be here. Okay, CPE verification poll number 1 has been launched, everyone. I'm going to do my best to keep an eye out. For some questions. All right. Looks like almost all of you have gotten your responses in. So take a minute to locate CPE poll number 1 and get your responses in here. All right, so new format for our statement of revenues, expenses, and changes in fund net position. I have an illustration coming up here, but all subsidies are non-operating revenues and expenses. And then subsidies can be non-capital subsidies, or they could be not non-capital and would be capital subsidies and default into presentation with other non-operating revenues and expenses. So we are going to group together our non-capital subsidies, and then we're going to report other subsidies in this other non-operating revenues and expenses section. Non-capital subsidies are going to be reported in a cluster immediately following the operating income or loss. And we are including subtotals for that new piece of classification. So subtotals for non-capital subsidies. I'm going to actually skip ahead to the illustration here. This is an illustration of where we pick up. So above here, we would, what's not shown would be operating revenues and operating expenses with their applicable subtotals. And then we would drop into operating income or loss, right? First subtotal presented here. Next area that's required is our non-capital subsidies. Immediately following our operating income, we have a subtotal for those non-capital subsidies, and then an additional subtotal for operating income or loss and non-capital subsidies, which is really the number that GASB was striving for. What is funding these operations? Subsidizing these proprietary funds, enterprise funds, and potentially internal service funds here. All right, so that's a new requirement, new subtotal to be presented. Then we get into our other non-operating revenues and expenses. And I'm stressing that terminology because all subsidies are the non-operating. It's part of the definition of non-operating. Presentation-wise is where we have to start splitting our non-operating between non-capital subsidies and other non-operating revenues and expenses. So here you have some examples. Again, these capital contributions, transfers in would be those limited to capital purposes. We'll have a Q&A coming on limited in a moment here, but keep your eye out on that. We have another subtotal if we do have any unusual or infrequent items, and for illustrative purposes, we are showing a sample here. This government experienced an earthquake. In the presentation of unusual or infrequent items under 103, we do have to separate inflows from outflows in the presentation on our financial statements. So we're showing grant revenues inflow, emergency response, and cleanup expenses as our outflow. All right, pretty used to the change in net position presented here and the reconciliation between our beginning and ending net positions. All right, this illustration is fun. We are reporting the pre-GASB 103 format that we would see here, and then the post-GASB 103 implementation format. The red items highlighted as really focusing in on what moved. I just want to highlight here, I have transfers in under non-capital and transfers in under other non-operating revenues. So keep your eye out for the identification for transfers in and transfers out for intergovernmental revenues, non-capital versus those that are considered capital contributions. All right, hopefully this all looks semi-familiar to most of you as we are in this implementation right now. All right, the exposure draft itself was posted in February. It is open for public comment until April 27th. So until next week, GASB is taking public comment. And I do have a slide coming up for how you can reach GASB. They do have a form available, an online form available, targeted specific questions and targeting feedback. We used to always write formal letters to GASB, and they have adjusted that. So that's an option for you. I also, in the handout section of your in your learning management system for today's webinar, I went ahead and posted the exposure draft of the implementation guide. So you can download the PDF directly from there. We pulled that straight from GASB's website. You can also use the link that I have coming up here. All right, all of these are proposed. This is not category B GAAP at this time. So I'm going to roll through these questions. I'm introducing these questions to you. I will add commentary. But we know, excuse me, we know that this is an actively, this exposure draft is being actively commented on. So I am confident that the way that changes will be made. I'm not going to say changes are going to be made to every implementation guide question, but we anticipate changes coming from GASB in their redeliberations of this. I will say too, GASB has a podcast called Bridging the Gap, and Lisa Parker, a GASB staff member, is on a recently a recent episode of that podcast talking about the implementation guide and how it's a staff document intended to assist practitioners with the implementation of standards and guidance. So the GASB board votes to not object to the issuance of an implementation guide, which is different than how they vote to approve the issuance of a standard. So I just say that to kind of take shape as we move through here. All right, questions. The first few questions here are specific to healthcare entities and higher ed entities, which are the two entities that are going to feel the biggest challenges with the implementation of the proprietary fund changes coming from 103. Anyone on the line, put in the Q&A if you're coming from healthcare or you're coming from higher ed. It'd just be interesting to know. All right, so this first question is on Medicaid payments here. And so we have a government providing supplemental payments to the hospitals. Do those supplemental payments received by the hospital that reports as a BTA or an enterprise fund meet the definition of a subsidy? So what we're talking about here is fee-for-service or managed care supplemental payments, right? The government, usually the state government, providing Medicaid outflow is contracting with medical providers. The government is contracting with the medical providers as medical providers report as BTA or enterprise funds. The government's providing assistance to hospitals based on services rendered, again, fee for service or a fixed fee payment for the managed care to the hospital, to the medical provider, based on the individual members enrolled in the health plan. Okay. This is different than an individual showing up at the hospital and having their insurance, their private healthcare insurance, cover their hospital bill. That insurance company is paying on behalf of the individual patient. When we're talking about Medicaid, the government is providing payment to the medical providers, the hospital systems, as an assistance payment. So I did bring up a reminder here, the definition of a subsidy: resources received from another party or fund. The proprietary fund does not provide goods or services to that provider, and it would directly or indirectly keep the proprietary fund's current or future fees and charges lower than they otherwise would be. So the government providing those Medicaid payments to the medical providers is not receiving goods or services from the medical provider. And if not otherwise provided, if the medical provider or the hospital was not otherwise receiving the Medicare payments, current or future fees would likely be impacted. Okay, so the conclusion here that GASB is giving is that yes, these Medicaid payments would meet the definition of a subsidy, and we have the logic here. We do, add in some acronyms here. Okay, CPE verification poll number 2 has been launched, so please take a minute to respond to that. I'm going to check my Q&As. Did I get, okay, I got no healthcare providers or I got no healthcare entities or higher ed on the line here. I was going to say that we did add in, bringing in these questions, we have added some acronyms included here. So take a look at the actual text if this is impacting you. I will say, you all know with implementation guide questions that, analogizing these to other transactions starts becoming very common. So we care about these, even if we're not a healthcare or higher ed provider. Okay. I think I have 3 questions on colleges and universities, so I'm going to roll through these. In the first scenario, the higher ed directly receives donations from individuals who are not students. So the answer here in this scenario is yes, those would meet the definition of a subsidy. They are not the parties providing it, the individuals providing that donation to go towards future scholarships is not receiving services from the higher ed, and the current or future rates would be lower than otherwise if we had not received them. So this does raise a question. What if a big donation comes in from a wealthy estate and the higher ed entity does not change tuition rates because of it? Okay, so GASB has a question on this, and the question comes up, and it is like that. Would we get the same answer that it is a subsidy, even if tuition rates do not change based on the donations? And their answer is no. The answer does not change, regardless of whether the published tuition rates change. Donations for scholarships, donations from an individual directly into the higher ed institution are considered subsidies because they're either directly or indirectly keep the future tuition rates lower than they otherwise would be, even if the receipt of a large donation does not change the stated tuition rates. All right, another question for higher ed. This is around research grants. Okay, research grants have frankly always been complicated for higher ed entities. And that's because research grants can be exchange or non-exchange. Research grants that meet the exchange transaction guidance are often tagged as contracts. And then non-exchange transactions, we often use the terminology research grants. Complicated in revenue recognition, also complicated for CFR reporting as well. So the question that is in the implementation guide is, are research grants considered subsidies? And the question itself picks up on paragraph 14A2. If we pick up on paragraph 14A2, we are implying that it already meets 14A1. And 14A1 says resources received from a party not receiving goods or services. If the party is not receiving a good or service, it is not an exchange transaction. This question is talking about research grants that are non-exchange. Okay, exchange transactions are a whole nother ballgame with research grants. We are picking up on this one. It is a non-exchange transaction. And then what are we, does it meet the definition of a subsidy? So the answer, and I don't have any higher eds on the line, but I will just talk through this for a moment here. The answer depends on the substance of the transaction. And so the GASB staff have put together two scenarios. One being, does it keep the tuition lower? It's going to depend. So in our first one here, if the research grants are used to offset operating expenses, such as salaries and other costs that would exist in the absence of the grant would meet the criteria under paragraph 14A2 and would meet the subsidy classification. It's covering costs that would exist in the absence of the grant. In the second scenario, the second bullet point here, it's the research grant received is not covering costs that would exist without its existence. It's funding and almost like funding an additional program. So in those circumstances, it would not meet the criteria of a subsidy. Kind of interesting conclusion. This question does not mirror the format of the other questions, which speak to both sub-bullet points in the subsidy definition. So this one's a little bit tricky. I anticipate this question is going to see some changes in the final implementation guide. All right, next question. Do taxes imposed by a business type activity meet the definition of a subsidy? And this is what we expected. Their conclusion is yes. Taxes such as property taxes are received by an enterprise fund, by a business type activity would be a subsidy. Without the collection of the tax, fees and rates charged by that proprietary fund would need to be higher. All right, so some conclusions there for you. Passenger facility charges, another entity-specific question for airports. Any airports on the line? You have been waiting for this question coming from GASB. So this is the charge that when a passenger books air travel, the passenger pays about $4.50 per leg of your trip to the airline. I'm going to pay it to the airline. The airline takes those funds and turns them over to the airport. They are revenue to the airport to pay for limited things. And passenger facility charges are usually limited to capital improvement at that facility, at that airport facility. So the question is, does my airport enterprise fund, does my airport standalone business type activity entity, do these passenger facility charges meet the definition of a subsidy? And GASB's staff conclusion in the implementation guide is yes. This one is kind of tricky because it's talking about who is the customer and who is benefiting. So in the situation, the passenger, the individual is paying the passenger facility charge. The airport is ultimately receiving it, but I'm not the customer. And I did recently book air travel. I did pay $9 in a passenger facility charge. I checked my email this morning. I'm paying the airline. I'm a customer of the airline. I'm not a customer of the airport. The airport's customer are the airlines and the concessionaires at their property. And so who is benefiting, who is the customer and who is benefiting. So that's where they kind of detach the passenger facility charges. Their conclusion is yes, it meets subsidy. I will say our answer does not clarify if it's a capital subsidy or a non-capital subsidy. So we're not getting that answer in the conclusion to this question, but they are saying their proposed answer is that it is yes, a subsidy. All right, that introduces how should subsidies other than non-capital subsidies be reported? And they're saying all subsidies are non-operating. Non-capital subsidies get shown separately in the statement of changes, and capital subsidies would be reported in that other non-operating revenues and expenses where we saw capital contributions in our illustration a few slides ago. Okay. We have some additional guidance, additional questions on this too, coming up with the terminology of limited for capital. There is a reference here too to an existing implementation guide that was amended with the implementation of 103 that you all can take a look at as well. How should subsidies be classified if the provider of the resources limits the use to debt service for capital related debt? This is so interesting. It's pretty logical. We're saying that if a subsidy is limited to debt service on capital related debt, it is a capital subsidy. We know that the character of the debt follows the use of the proceeds. So when debt proceeds are used for capital project work, that debt is considered to be capital in nature. So now the subsidies that the proprietary fund is the proprietary fund is receiving subsidy inflow specifically to pay debt service requirements, principal or interest on capital related debt, that the inflow of that subsidy would take on that capital character. Again, we're using the term limit. It's not restricted. I have more on that coming up on the next slide here, but that was purposeful. GASB is using limit and not restricted. Limit is lower than restricted. Restricted comes with that connotation of third-party restricted. If we don't do what the third party says, somebody can sue us and pull back the money. So limit is kind of less strict than restricted. All right, we do have an update to an implementation guide question, and I like the way Todd put together this slide. He actually mocked up the changes. So this question was from 2025-1. It was from last year, and we have an amended coming in here. How should subsidies be classified if the resources are used for the acquisition of capital assets in circumstances in which the use of the resources is not limited by the provider to the acquisition of capital assets? So we received money and we used it for capital purposes, but nobody required us to, and there were no limitations from the provider that said we have to report them as capital. So the answer goes into, unless there are external limitations, external restrictions, potentially legislation, regulation, limit to the use resources to capital purposes, the subsidies should be classified as non-capital because the resources were not limited. And we're kind of familiar with that. If it's not restricted or limited for certain things, the default is that it's going to be non-capital. We saw this with, I don't want to analogize to ARPA, but we saw this with ARPA. It wasn't considered an operating grant. It wasn't considered an operating grant in the statement of activities because we could have used it for anything. So we reported those ARPA, those COVID relief funding receipts, as general revenue on our statement of activities. A similar conclusion. All right, the proposed effective dates. I mentioned this at the top of this section here. A little bit staggered because they're not going to have this issued by June 30th, 2026. They can't require June 30th, 2026 governments to implement it. But all those June 30th, 2026 governments are required to implement 103. We need to have a plan to watch this exposure draft and watch the deliberations. If you're going to be impacted, definitely, a heightened interest around those healthcare, airports, and higher ed entities. And they're saying early implementation is definitely encouraged if the government has implemented 103. So all of our 1231 governments, even the September 30th governments, I anticipate you guys are going to feel some pressure internally and from your auditors to get the implementation guide on subsidies implemented alongside your implementation of 103. Links available. Download the exposure draft. Take a look at the actual language provided in there. I also have the link to the survey participation. Everyone's welcome to draft a formal comment letter if that is your style, but you can also participate in the survey online question format that GASB has. You're going to see that with the infrastructure assets as well here coming up. Has anyone ever written a comment letter? Post in the Q&A if you have written a comment letter and what the project was, because this is, GASB takes our feedback. On the podcast from Lisa Parker, she talked about how the staff reviews every comment letter that they receive and addresses many of them in the deliberations with GASB. All right, infrastructure assets. This exposure draft was just, it was issued in March. I think we just got it a week or two ago, published to their website. So this one is also available. Public comment is open for another 2 months here, so until June. Everyone who reports infrastructure assets, please don't tune out here because this one is not super fun. Okay, we have someone who did send and commented on the financial reporting model exposure draft. So pretty cool. It's nice to participate. All right, some background on infrastructure assets. I mentioned that we had a preliminary views on this so it was issued in September of 2024. So this time last year, we were all digesting that PV document. We had a conference session on where that stood last year as well in DC. But the idea, our capital asset reporting, the idea of identifying infrastructure assets to be reported in our financial statements all came from GASB 34, our original financial reporting model statement. 103 is what's largely amending GASB 34 here. So this is an interesting piece. GASB board regularly revisits all of their reporting requirements. So they were revisiting reporting requirements around capital assets, and the pre-agenda research showed no big issues with accounting and financial reporting of general, capital assets in general. They did identify some needs around specifically infrastructure assets. So they moved forward with the project targeting improved accounting, financial reporting, and disclosures. Recognition, measurement, and note disclosures around infrastructure assets. So again, we had that preliminary views in late 2024 and the exposure draft that we are looking through right now, approved last month, posted earlier this month. All right, CPE verification poll number 3 has been launched, everyone. You will likely have a 4th chance here, but do your best to find that screen and get your responses in. It's up for a full 90 seconds, so I will revisit with you. I'll get back to the content. You can find that screen and get your answers in. All right, so the definition of infrastructure assets is changing with this exposure draft. And you can see here we have the existing definition with the codification reference with the proposed new definition in this exposure draft. Infrastructure assets, though, these are all long-lived capital assets, stationary in nature, and expected to be preserved for a significant number of years. That's what we're starting with, what we're working in right now. So under our proposed definition, we have some introduction of some new terms that are easy to stumble over as you digest this exposure draft. Capital assets that are part of a network of assets. Infrastructure assets are stationary in nature, maintained or preserved for a significant number of years. Okay. They have some examples. We've always had examples of infrastructure assets. Roads, bridges, tunnels, water and sewer dams, lighting, and we've introduced communication towers. Okay. In the preliminary views, they used communication networks, and they got a lot of feedback on the use of communication networks and if that met that it would be maintained or preserved for a significant number of years because of technology changes and the rapid change environment that governments work in. And so they did adjust that to communication towers as something that is expected to be maintained or preserved for a significant number of years. So kind of an interesting clarification, but I think speaks to they are listening to what you say. And as I was preparing for this webinar and reading through the exposure draft again, it's clear to me that in the basis for conclusions, they do talk about what they changed from the preliminary views and how they are taking what comment letter respondents are saying seriously. All right. Also a note here in the infrastructure assets, they do talk about buildings. They don't want non-essential buildings included as infrastructure assets. It needs to be a prevailing part of the asset. The primary purpose of the building is integral to the network of infrastructure assets. So keep that in mind. I think it's a higher bar under this proposed definition to include buildings as part of the infrastructure assets. You're going to see the network terminology come up again. I haven't, my next slide is speaking to this. Capital assets, infrastructure assets are capital assets that are part of a network of assets, stationary in nature, maintained or preserved for a significant number of years. So what is a network of infrastructure assets? You guys look here, we're using the acronym IA for infrastructure assets. Got to erase internal audit from your mind. IA in this slide deck is talking about infrastructure assets. We're adding a new terminology here. So our existing language, a network of internal infrastructure assets is composed of all assets that provide a particular type of service for a government. A network of infrastructure assets may be only one infrastructure asset, or it may consist of many components. Okay, so we have a new definition of what a component is. So we have network, now we have components to layer in here. A component is a separate, distinguishable part of the infrastructure asset that has a specific function in contributing to the service capacity of that infrastructure asset. And the example that is here is a road may consist of a roadbed, overlay, curbs, and gutters. You're going to see this in the illustration in the exposure draft that all of these components, if they are significant to the network, should be, if they're significant dollar value to the network and have meaningfully different estimated useful lives, we should be capitalizing those components separately. we're going to get to the disclosures. The disclosures will be done in this exposure draft are proposed to be done by network, not by component. It's important to recognize the components. Again, significant dollar value and meaningfully different estimated useful lives would be capitalized and depreciated separately. But when we roll into the note disclosure requirements under this exposure draft, we would be disclosing by network. So the roadbed, overlay, curbs, and gutters could all have, if significant dollar values attached to each of them, could be depreciated over different estimated useful lives. They would all roll up into the road network note disclosure. More to come on that. Okay, I'm trying to get through all my slides here. Governments reporting infrastructure assets still have two options: report under the historical cost or modified approach. If you're reporting under the historical cost net of accumulated depreciation, again, we're going to be capitalizing and depreciating the components. Sometimes there's one component, sometimes there's more than one component. We're going to be capitalizing them and depreciating based on their estimated useful lives. This exposure draft, we saw it in the preliminary reviews, emphasizes and requires periodic reviews of estimated useful lives of salvage value. You're going to see a note disclosure coming up in a bit where GASB is proposing that governments tell them how much the dollar value of your infrastructure assets that have exceeded 80% of their estimated useful life, or those that are fully depreciated at 100% of their useful life. You're going to see that coming up. So their requirement here is they don't, infrastructure assets, long term, we're expected to get, a significant life out of these 50, 100 years. We're talking large numbers, right? That they, and the maintenance and preservation going into these infrastructure assets, hopefully is allowing those infrastructure assets to continue to live on. So they're requiring governments to take a periodic review. They don't tell you how long that is, how often that periodic review is. They don't tell you how to document it, but it is in the statement language, the exposure draft language, not an official statement yet. All right, for modified approach, anyone on the line, post in the Q&A if you report any infrastructure network under the modified approach. If you use this, you can do modified approach for only your bridges or only your roads or only your communication towers. You do not need to report all infrastructure assets under the modified approach. We see this in large county governments. We see modified approach common in state governments as well, right? With the idea being, we've put these infrastructure assets into place. We are going to maintain them and preserve them to exist forever. Like, the bridge is not coming down. We are going to do what it takes to preserve that infrastructure asset to remain up indefinitely. And if we commit to that and we structure condition levels and we do our regular engineering studies to confirm that we are maintaining and preserving it at the expected condition level, we don't depreciate the infrastructure asset. It stays up at its cost. We expense those annual maintenance and preservation expenses in the year they occur, which kind of replaces the depreciation expense recognition. The asset will exist indefinitely. We're going to expense our maintenance and preservation costs. So what we have right now is that the government has an asset management system in place to track their eligible infrastructure assets that are reported under the modified approach. And again, they're reviewing, doing periodic reviews and the condition level. And so those are required to be done every third year. So our next slide shows the existing criteria for modified approach and the proposed criteria. I've got CPE poll number 4 is launched. I've got y'all for another 10 minutes. And I think I've got 10 slides to get through. So get your answers into CPE verification poll. I'm going to continue on with the content here. So some adjustments coming from the criteria under the exposure draft of infrastructure assets. They do take away that asset management system, which was kind of a heavy term. And a lot of governments, I think, gave GASB feedback saying, like, we do this, we accomplish this in Excel, and it doesn't feel like it meets asset management system. So they removed that language, noting that governments have, options for how they can maintain this information. But we still have to maintain up-to-date inventory records, perform those condition assessments, estimate each year the annual amounts to maintain and preserve those assets. We're going to present that in a schedule in RSI in the required supplementary information of the financial statements. And then they do have a new change here in D, maintain documentation demonstrating that those infrastructure assets are being preserved at or approximately at the condition level that they've established. So you see, if you are a government that reports infrastructure assets under the modified approach, you have some additional RSI schedules that speak to the condition level and the costs incurred around it. All right, so in the exposure draft, our capital asset note requirements here, the proposal is that infrastructure assets, right now, we can report infrastructure as a single line in our note disclosure. It includes all of our roads, all of our bridges, all of our communication towers. Under this exposure draft, they're telling us that those infrastructure assets would need to be desegregated by network, not by component, by network. And that we would have in that capital asset note disclosure, if the government has a policy for monitoring, maintenance, and preservation of infrastructure assets, that they would disclose that policy. So that's, potentially a larger government concept here. Be interested if you all recall, and this would be, I think infrastructure assets too, accounting is going to have to talk to public works. They're going to have to talk to engineering departments at your government for a lot of this information. All right, let's continue. Then for historic governments reporting infrastructure assets under the historical cost, net of accumulated depreciation. Look at the bottom bullet point here. Infrastructure assets by network that have exceeded 80% of the useful life. We need to state the historical cost and accumulated depreciation. We need to provide a historical cost weighted average age of that infrastructure asset network. Remember, the network could have multiple components. So we would be sorting through and calculating a weighted average age. GASB's exposure draft does have an illustration of how this calculation would be accomplished. Then, if we have infrastructure assets that have reached 100% of their useful life, they are fully depreciated, we would need to separately disclose the ones that are fully depreciated, 100% or more, and those that are between 80% and 100%. All right. I know, we're having fun, right? I'm actually, so a little bit of information on the historical cost weighted average and what this means. When I get to the end of the slides, I'm going to pull up the exposure draft illustration and show you all how GASB is calculating it. But this is, more or less a narrative for how we would get this done. So using the modified approach, the proposal, I think this is from paragraph 12 of the exposure draft, does eliminate the description in the significant summary of significant accounting policies. And that's because we have some changes to how we're reporting the required supplementary information here. Again, RSI schedules are by network of infrastructure assets. So, and we're changing it. Previously, we were reporting RSI trends data for infrastructure assets under the modified approach for the past 5 years. This exposure draft is proposing it be expanded into 10 reporting periods. We have some information in supplementary information that is, I think this is coming from paragraph 15, but the footnote encourages governments that gather information for RSI that do not use the modified approach to provide information as supplementary information. this footnote would be getting eliminated. A little bit of a workup here and some one thing to note here with the implementation. So the exposure draft has to give a proposed implementation date. Fiscal years beginning after June 15th, 2028. So if we're beginning after that, my reporting year, fiscal year ends June 30th, 2029, would be the first required implementers of this. But look, this is prospective. Overall is prospective. We have a few exceptions to it being prospective. If components are deemed separate infrastructure assets, we would get that implemented with that historically implemented. Paragraph 7, periodic reviews of estimated useful lives. They're saying review that, and if you had any assets that were, potentially going to live longer, going to be used in services longer than you had reported the estimated useful lives to be, to potentially to take this as an opportunity, take this implementation as an opportunity to restate beginning net positions. If I had I don't know, I'm just going to make it up a number. If I had a bridge that at the implementation of this standard had an estimated remaining useful life of 10 years, but I knew I was going to get 50 years out of it, I would go back and restate net position with this implementation. So definitely more complicated transition guidance here. Some additional requirements around these look like the note disclosures. Again, division by network of infrastructure assets. Comparative financial statements would have special provisions, special transition provisions here as well. All right. And that's nice. Paragraph 13. So in the 10-year trend data, they say you can let it grow how we've typically let our RSI trend data grow over the years. Okay. Exposure draft is here. I'm going to pull up, I've got 3 minutes left with y'all. I'm going to pull up the illustration coming from GASB's exposure draft. So this is the PDF, and I'm just going to flip through this with you. I'll stay on the line a few minutes after the top of the hour to look at the questions. We'll cut the recording and I can just talk through some of the questions for a minute here. If you have a question and you want my eyes on it, post it up. All right, so this is Appendix C. Again, illustrations coming from GASB are non-authoritative, but they're illustrating how we would accomplish ultimately the disclosure of infrastructure assets that exceed 80% of their estimated useful lives. Okay, so we have an assumption a county government has infrastructure assets that consist of networks. Our network is roadway and bridge. The assets in the roads network have multiple components. And these are meaningful. These are meaningful dollar values. Oh, my highlights are not working well. Meaningful dollar values and meaningfully different estimated useful lives. This is when we're triggering separate capitalization of components in the network under this exposure draft. Same item with the bridges as well. These are probably geographically different bridges that we're going to capitalize as infrastructure assets and are going to be presented as a bridge network in our note disclosures. Okay. You can see here at the end of our fiscal year, some of these are exceeding the useful lives. So I have a road that's at 34 years. I have a road that's at 13 years. And I have a road overlay that is 13 years to a useful life of 15 years. So I know I'm in that 80% bucket here. So they're taking, now I've got a bridge at 62 years. So this is, I believe, what they're speaking to with the transition guidance, with an opportunity to restate beginning net position based on the expected estimated remaining useful lives coming out of these infrastructure assets. All right, so we come down here, we're identifying ones that are above 100%. Yeah, so 62 and 50 and 30 and 31. And then they're calculating the historical cost weighted average of these assets, of this network. When we come into the disclosure, it's going to be by network, not by component. All right, same item here. They have the calculation, total historical cost times age divided by total historical cost is giving us the calculation here of the 2.4. I'm sorry, the calculation here of the 32 years. So 32 years, historical cost weighted average age of these assets that have exceeded 100 years. Same concept here. They break out the calculation. We have our historical cost weighted average age of 55 years for the bridge. Now we're doing it separately for 80%. Again, identifying the components in those networks and calculating a historical cost weighted average. When we come into the disclosure, this is GASB's disclosure here. When we come into the disclosure, draft, I don't know why I have this up here. I think I have this up here, highlighted roads, because I'm going back and forth between component versus network. It is clear in their illustration, which is not authoritative, but it is clear that the disclosure is focused on network. We're talking roads. We're not talking component. I think that's important. But this is the narrative that they're describing, not only the historical cost and accumulated depreciation, but also the historical cost weighted average age of the infrastructure network. Not of the specific portion, the weighted average age of that $75 million portion of the infrastructure asset. All right, this is really fun. We're at the top of the hour. Karen, do you want to cut the recording and I will take a look at the Q&A? Oh, good question. Does GFOA issue comment letters on the 2 exposure drafts? GFOA has committees that issue comment letters. Thank you. Thanks, Karen. So GFOA's Accounting, Auditing, and Financial Reporting Committee reviews exposure drafts and drafts comment letters to be submitted to GASB. Really good question. I'm not sure if anyone on the line is participating in that committee, but that's a really good question. Resources from disposal of capital inventory. Would this also include any losses on disposal and salvage? Yes, it would. I do say that there is a basis for conclusion paragraph around inventory and like the disposal of inventory. It's disposal of significant inventory. Not necessarily the use up of inventory recognized as use by the government. So there's a basis for conclusions paragraph around the inventory component of that question in GASB 103. Oh, will comment letters be available for us to see before the deadline? You know what? I'm going to share my screen again with everybody. I'll highlight here, we do have in the handouts folder, again, some handouts for you. That you're able to access, including the PDFs of the exposure drafts. If you go to GASB.org, you can see current comment letters. If you come to I'm at GASB.org, I'm at the top panel, projects, comment letters, and I can see comment letters that have been submitted for the implementation guide right now. They've received 18 comment letters, it looks like, on the implementation guide. I wonder if they've gotten anything on infrastructure assets. Nothing on infrastructure assets yet. That one really, I think a lot of people are still digesting. But you can see here, I'm not sure, a lot of public accounting firms participate. This is a healthcare heavy standard. So we've got a handful of people from a specific healthcare entity individually responding. So they do tag, it's difficult to look at form letters. So it looks like those might all be the same type of response here as they're labeled A, B, C, D, E. Association of Government Accountants responded, Florida Institute of CPAs, Iowa Healthcare. We know that GASB 103 is going to be more challenging for our colleges and universities, for the healthcare entities, for the airports. All right, good questions. Thank you all for participating today. I don't know. It's good to have you. Good to talk through these. Please come to GAAFR Plus Forum if you have specific questions or observations or thoughts around here. Let's get the conversation going kind of in the smaller community where everyone has access to, I talk as a smaller group, not necessarily general forum type conversations. All right. Have a great afternoon, everyone. Thanks for joining us.